Credit utilization is wrecking your score. Fix it this week. The number that's quietly destroying your credit 30%. That's how much of your entire credit score is determined by one single number that most people have never even heard explained properly. It's not whether you pay on time. It's not how old your accounts are. It's your credit utilization ratio. And right now, there's a very good chance it's dragging your score into the dirt without you even knowing. I talk to people every week who pay their bills on time every single month, and they still can't figure out why their score is sitting at 620. They're doing the thing everyone told them to do, pay your bills, and the system is still punishing them. That's not an accident. The credit scoring system wasn't designed to be intuitive. It was designed by companies that sell your data to lenders. So let's talk about what's actually happening, how to fix it, and why the common advice you've heard is probably only half right. What credit utilization actually is, credit utilization is the percentage of your available credit that you're currently using. That's it. Simple math. If you have a credit card with a $1,000 limit and you've got a $500 balance on it, your utilization is 50%. If you have two cards, one with a $1,000 limit and one with a $2,000 limit, and you owe $500 total, your utilization across all cards is about 17%. The formula is total balances divided by total credit limits times 100. That gives you a percentage. FICO and Vantage Score both look at this number heavily, and here's the part nobody tells you clearly enough. They look at it on each individual card and across all your cards combined. So even if your overall utilization is fine, one maxed out card can still tank your score. Let me give you real numbers. Say you have three cards. Card A has a $5,000 limit with a $200 balance. Card B has a $3,000 limit with a $100 balance. Card C has a $500 limit with a $480 balance. Your overall utilization is $780 out of $8,500, which is about 9%. Looks great on paper. But Card C is sitting at 96% utilization on its own. That individual card utilization is a red flag to the scoring model. Your score takes a hit even though you're barely using your total available credit. The system doesn't care about context. It doesn't know that card C is the gas station card you forgot about. It just sees a nearly maxed out account, the thresholds nobody talks about. Honestly, you've probably heard someone say, keep your utilization under 30%. That advice is everywhere. It's on every personal finance blog. It's repeated by bank customer service reps, and it's mediocre advice at best. 30% is not a target, it's a ceiling. And honestly, it's a pretty generous ceiling that mostly benefits the banks. Here's what the data actually shows. People with FICO scores above 750 typically have utilization under 10%, not 30, not 25, under 10%. And the people with the absolute highest scores, many of them sit between 1% and 3%. So when someone tells you 30% is fine, what they really mean is 30% won't completely destroy you. That's a low bar. It's like saying eating fast food every day is fine because you haven't had a heart attack yet. Here's a rough breakdown of how utilization affects your score. 0% can actually be slightly worse than 3% because it looks like you're not using credit at all. 1 to 9% is the sweet spot. 10 to 29% is decent, but you're leaving points on the table. 30 to 49%, and you're starting to see real damage. 50% and above, and you're actively bleeding points every single month. I once watched someone's score jump 43 points in a single month. They didn't open a new account. They didn't dispute anything. They paid down one credit card from 72% utilization to 8%. That was it. 43 points from one payment. The scoring model recalculated, saw the lower utilization, and rewarded it almost immediately. That's how sensitive this number is. The reporting date trap. This is where it gets really annoying. Even if you pay your full balance every month, every single month, never a penny of interest, your utilization might still be reported as high. Here's why. Your credit card company reports your balance to the credit bureaus once a month on a specific date. That date is usually your statement closing date, not your payment due date. So if your statement closes on the 15th and you spent $900 on a $1,000 limit card that month, the bureau sees 90% utilization. It doesn't matter that you paid it all off on the 20th when the bill was due. The snapshot was taken on the 15th. The damage was already done. This is one of the most absurd parts of the whole system. You can be a perfect borrower, never paying a dime in interest, never missing a payment, and still get penalized because of when a computer decided to look at your account. So what do? You pay before the statement closing date, not the due date, the closing date. These are two different dates, and mixing them up is costing people 20, 40, even 60 points. Call your card company or check your online account, find your statement closing date, then make a payment a few days before that date to bring your reported balance down. If your limit is $1,000 and you spent $800 this month, pay $750 before the statement closes. The Bureau will see a $50 balance on a $1,000 limit. That's 5% utilization. Your score will reflect that. This isn't a trick, it's not a hack, it's just understanding how the reporting actually works, which the credit card companies have zero incentive to explain to you. Why this hits harder when you're starting from scratch. Let's talk about why this matters even more if you don't have much credit history or if your limits are low, because this is where the math gets brutal. If you've got a secured credit card with a $300 limit, which is what a lot of people start with, and you use it for groceries and gas, you can easily spend $150 in a week. That's 50% utilization. Buy a few things for the house, fill up the tank twice, maybe grab dinner once. Normal spending. But the scoring model doesn't see normal spending. It sees someone using half their available credit and it reacts accordingly. When your limits are low, the margin for error is basically zero. A $200 balance on a $300 card is 67% utilization. That same $200 on a $5,000 card is 4%. The spending is identical. The impact on your score is wildly different. The system is built to be easier on people who already have high credit limits, which means it's built to be easier on people who already have good credit. Funny how that works. I've seen people with $500 limit cards do everything right, pay on time, keep balances low relative to their income, and still struggle to break 680 because their utilization percentage looks bad on a card with such a tiny limit. The system measures you by a ratio, not by the actual dollar amount. Owing $250 on a $300 card looks worse to FICO than owing $4,000 on a $10,000 card. Let that sink in for a second. So if you're starting with low limits, you have to be more strategic. Use the card for one small recurring charge, like a streaming service for $15 a month, and pay it off before the statement closes. That keeps your utilization around 3 to 5% on a $300 card. It's not exciting. It's not going to make a great Instagram post, but it works. The credit limit increase nobody asks for. Here's something free that takes about 5 minutes and can meaningfully lower your utilization without you changing your spending at all. Request a credit limit increase. If you've had your card for 6 months or more and you've been paying on time, most issuers will bump your limit if you ask. Some do it through the apps, Capital One, Discover, and Chase all let you request increases online without even talking to a person. Many of these are soft inquiries, meaning they won't ding your credit to check. Say you've got that $1,000 limit and you typically carry a $300 balance when the statement closes. That's 30% utilization. If they bump you to $2,000, that same $300 balance is now 15%. You didn't spend less. You didn't pay anything extra. The math just changed in your favor. Now, a warning, some issuers will do a hard inquiry for a limit increase, which can temporarily drop your score by a few points. Ask before you agree. Say the words, is this a soft pull or a hard pull? If it's hard, you need to decide whether the long-term utilization benefit is worth a short-term 5-point dip. Usually it is, but you should know before you agree. And do not use a higher limit as permission to spend more. The entire point is to make the same spending look smaller as a percentage. If your limit goes from $1,000 to $3,000 and you immediately start spending $20,500 a month, you've made things worse. The limit increase is a math tool, not a shopping spree. Your move this week. Here's what I want you to actually do. Not next month, not when you feel ready. This week. First, log into every credit card account you have and find two dates, your statement closing date and your current balance. Write them down. Second, if any card is above 10% utilization right now, make a payment before the next statement closing date to get it under 10%, even if it's just an extra $40 or $60. Third, if you've had any card for more than 6 months with on-time payments, request a credit limit increase through the app or website. It takes less time than ordering coffee. That's it. 3 steps, no software to buy, no course to sign up for, no credit repair company taking $89 a month to send dispute letters. you could send yourself. Your credit score is a game with rules that nobody bothered to print clearly. Now you know one of the biggest rules. Use it. Go check your statement closing dates right now. Pause this video if you have to, and set a calendar reminder 3 days before each one. That one reminder, repeated every month, is worth more than most of the credit advice you'll find online. I'll see you in the next one.